Hello, this is the first video in my cost of capital series, and I'd like to begin, if I may, with a reflection of what in finance we define as the goal of the firm, which is to maximize shareholder wealth by maximizing the value of the firm. We define value of an investment as the present value of all expected future cash flows. It could be for a firm, as in this case, whose existence is undefined, or it could also be for a project, as in this case, which has a defined economic life in. And either way, in addition to an estimation of the projected free cash flows, the numerator of this definition, which I demonstrate, by the way, in a different video, we also need to estimate the discount rate, right, R. And it is this discount rate that's referred to as the cost of capital. It is the cost of the debt and equity capital utilized in financing the firm's investments. And so essentially there are two sources of capital for a firm: debt and equity. In the case of equity, a few firms may have a preferred stock or preferred equity, if you like, in which case we need to be mindful of it in our estimation of cost of capital. Otherwise, the more predominant, more common type of equity, no pun intended right there, is common equity, which could be generated by selling new shares of common stock to outside investors, or it could also be obtained internally by reinvesting portions of the firm's net profits. All right, and so the task ahead of us is to estimate the overall cost of capital, the average cost of the debt and equity capital utilized in financing the firm's projects. If the firm has it, then we're going to also show, in addition to calculating cost of debt, also show how to calculate cost of preferred stock. Otherwise, we're just going to stay with the calculation of the cost of common equity, which again, like I said, cost of common equity may be calculated for common stock, which is generated by selling new shares to outside investors, or it could also be cost of common equity, which would be determined as the opportunity cost of the portion of the firm's profits that have been reinvested into the firm. That money isn't cheap and it isn't free, and so there is an opportunity cost of it, and that's what's being estimated when calculating the cost of equity. So now here we go with the cost of debt. But before I do so, I'd like to give you a reminder of how we calculated the value of a bond. As you know, bond is the instrument based upon which firms borrow money from the general public. And we explained that in my bond valuation series, we explained that there are essentially three variables we need to calculate the value of any investment, actually. And they're going to be the expected cash flows, the maturity of the investment, and the discount rates, which in the case of the bond is going to be the market interest rate, aka the yield to maturity, R. And so with respect to this problem, it says a 5-year bond with a par value of $1,000, which is pretty standard, has a coupon rate of 8% and interest is paid semi-annually. So for us to calculate the price of this bond, given a market interest rate yield to maturity of 7%, that is, we need to follow the call coding right here. So the blue refers to the expected cash flows, which in the case of a bond consists of the coupon payments. Since this bond pays interest semi-annually, the annual rate of 8% of 1,000 is $80 split into 2 will give us 40 every semi-annual. And then of course when the bond matures, you're going to get back the face value of $1,000. And so these are the two types of cash flows that you can expect when you buy a bond. And then the red variable here is the maturity of the bond, which is 5 years, but semi-annually speaking, it's 10 6-month periods. And then finally would be the market interest rate, which actually from the investor standpoint is also the required rate of return on the bond. So you can call it market interest rate, you can call it yield to maturity, you can call it the required rate of return on the bond. 7% semi-annually, 3.5. So you feed these into the calculator and you find the value of the bond to be 1041.58, which of course indicates that this is a premium bond. So here we go with my BA2 plus second clear TVM, second clear work. All right, clear work and clear TVM are both second functions. So we're going to stay here in the third row of keys. So in no particular order, so it's going to be 40 is our payments, and then 1,000 is our future value, which is also the face value of the bond. 10 is N, and then 3.5 is going to be our I over Y, and so we compute present value, compute PV. To remove this negative thing here, click the plus minus key, and that's your result right there. And so armed with that basic information, we're now ready to go ahead and calculate the cost of debts, which is the yield to maturity on a bond. And looking at the call coding here, this time in lieu of the market interest rates, which would have helped us calculate the price of the bond, we now are given price. And with that, we're ready to rock and roll and calculate the cost of debts, which is also the yield to maturity on the bond. So now check this out. It says a 5-year bond with a par value of $1,000. Again, that's pretty standard. If it isn't given, you have to assume it. Has a coupon rate of 8%. Interest is paid semi-annually, and by the way, bonds also pay interest typically semi-annually. So now suppose the bond is currently selling for 1,050. That's a premium bond because it sells for more than $1,000. It says now go ahead and calculate the yield to maturity, and in this case it's going to be the before tax cost of debt, and I'll explain why shortly. And then afterward we're going to calculate the after tax cost of debt, all right, given a corporate tax rate of 21%. So now follow the call coding. We need to know the cash flows. It's going to be the coupon payment of $40 every 6 months and the face value of 1,000 when all is said and done. The red refers to the maturity of the bond, 5 years. Semi-annually, it's 10. And then value of the bond is 1,050. So we feed these into the calculator, and I'm going to do that real quickly right here because I do want you to pay attention to a certain operation right here. So second clear TVM, second clear work. So again, it's going to be 40 is our payment, 1,000 is our face value, and then we're going to put in 10, that's our N, and then 1050 with a negative now. Anytime you put in PV, put it in as negative, all right? That way when you calculate your result, it comes out nicely. So now we compute I over Y. So this rate of return that you see here on the screen is not the correct answer. This is the semi-annual yield. So you have to double it as I demonstrate right here. So just simply go times 2, all right, to get the correct yield to maturity. So this yield to maturity is the before tax cost of debt. All right, now it is before tax because we're mindful of the fact that for the investor, this yield to maturity here represents his or her required rate of return on the bond. To the firm though, this is the before tax cost of debt. Noting that interest paid on debt is tax deductible, we need to carry out this adjustment that you see right here. And so we're going to have to be reminded in this example that tax rate is 21%. So on an after-tax basis, 1 minus 21, it's 79. All right, so we're just gonna carry out that little operation, multiply this by 1 minus 0.21, which is 0.79. So times 0.79. And ladies and gentlemen, 5.37 is indeed our after-tax cost of debt. So the effective cost of debt to a firm is indeed the after-tax cost of debt. All right, and so, and of course, if we are already given the after-tax cost of debt as in this example of 10%, we can back up and find the before tax cost of debt, which would be the yield to maturity in the firm's bond, as I demonstrate right here, right? So this is the after-tax cost of debt. See the definition right there, which is given to be 10%, and so just simply solve for RD, dividing 0.10 by 0.79 to get 12.66. So now here is a practice for you. It says a 14-year corporate bond with a coupon rate of 5.8%, semi-annual interest payments are made. Currently sells at a discount, actually 918. So it's below 1,000. That's why it's a discount bond. So now we want to calculate the before tax cost of debt, which is the yield to maturity, and then afterward also calculate the after tax cost of debt, assuming a tax rate of 25%. So I've set it up for you right here quite so nicely. The blue consists of the cash flows, the red is the maturity of the bond semi-annually expressed, and the green is the current price of the bond. And I actually mean this to be 930. So let's go in there and sneak in 930. All right, so now we're good to go. All right, so with that, solve for your RD, make sure you adjust it for annual, and then solve for your after-tax cost of debt. And that's a wrap.